Hello, everybody, and welcome to this live broadcast from our headquarters here in Johannesburg. We're here today to talk about transition finance in Africa. I'm Godfrey Mochizwa. I wanted to start with a question. Is Africa short of development finance? The answer is no, and this is according to the African Development Bank. The bank estimates that pension funds alone sit at $1.1 trillion, and this was last year. And if you add the remittances that have been coming to the continent, that number shoots up to 1.6 trillion by 2035. Now, the bank further also estimates that the right policies, Africa could mobilize an additional 1.4 trillion in domestic resources from tax and non-tax revenue sources. And get this is through efficiency gains alone. So the money is here. We're not short of money. And I know that's a bit of a bold statement to be making in front of bankers, right? But what appears to be short, in my view, is how to use that money innovatively for one of the greatest needs of our time, the great energy transition, which is why we're here. So let me begin by introducing our speakers.
The panelists are Tshepo Ntsali, Sustainable Finance Transactor at RMB. Nathaniel McClim, Co-Head of Emerging Market Alternative Credit at 91. Ellen Brooks, Manager of Climate Change at British International Investments. And Donnie Crenier, Senior Vice President of Business Building at Sasol.
Transition finance refers to funding provided to high-emission sectors like steel, cement, oil, gas, and aviation to help them reduce their environmental impact over time. Africa requires $1.4 to $250 billion annually for transition finance. Unlike traditional green finance, which focuses on already sustainable projects, transition finance supports industries that are not yet green, but have credible plans to decarbonize. It enables realistic decarbonization, presents significant investment opportunities, fuels innovative financing, and the development of new technologies. However, transition finance comes with risks. The risk of greenwashing, the lack of clear definitions and global standards means there is confusion about what qualifies as a legitimate transition activity, and transition finance impact can be slow. Despite the challenges, transition finance opens key opportunities. It can support developing economies and drive job creation through upskilling of communities. It also encourages policy innovation by motivating governments to develop clearer taxonomies, reporting frameworks, and incentives.
Thank you. And welcome all, lady, gentlemen. Thank you for your time. Tshepo, let me start with you. Let me have your key understanding and definition of what transition finance is and what it portends for the continent.
Thank you, Godfrey. I think it is important to understand transition finance in this sense. So what you are looking at here is an asset class whereby you support corporates raise funding to decarbonize their operation, particularly in the hard-to-abate sectors. These are sectors whereby in the near term and medium term, there are no alternative technologies to go completely green. But there's an acknowledgement that these sectors need to decarbonize. You're talking aluminum, iron and steel, petrochemical, and also the enabling sectors like your critical minerals. So there's an understanding within the sustainable finance environment that some of these sectors need to decarbonize in the immediate term. And that's where transition finance comes in. You are funding real-world decarbonization anchored on transition plans and transition strategies. So that is the differentiation. And there are some principles that you need to consider, that your plan has to be aligned with the latest science, with the Paris Agreement, You need to have transparent reporting and monitoring, but you also have to avoid, there's a concept called carbon lock-in. So whatever technology that you are funding or within each sector, you have to consider that you're not impeding or obstructing the development of other lower carbon opportunities. And that is why transition for us is quite an exciting opportunity, because we can also help those sectors that are not green to also decarbonize.
Yeah, so let me ask that question again. Is the money there?
The money is available. So the money is available. What is important is to show the impact.
Right.
So all the money that goes into transition finance needs to demonstrate a actual reduction in carbon dioxide or greenhouse gas emissions. That is the important part.
Yeah. Ellen, please come in. You bring an international view on this and hopefully experiences from other parts of the world where they're dealing with this.
Yes, absolutely. So BII is the UK's development finance institution, and we invest across Africa and South Asia, and I'm in the climate change team. So your question was, is the money there? I think absolutely climate-focused investors want to move into this space. We absolutely can't get to net zero. We can't limit warming to below 2 degrees with a goal of 1.5 without focusing on sectors, companies that are high emissive today, but have that strategic intent to transition. And I think that's why transition finance is so exciting. If we can crack this definition, then I do really believe the capital will start to flow.
Do you see challenges in terms of enabling that flow of money into transitional finance?
Yeah, absolutely. I think we're really at the foothills of what is a really exciting area of sustainable finance, but it is new. That's why we're here today. I mean, I think we all see the potential, and we're all working through as a collaborative group. How do you have a definition that you can trust? Because when we invest in green things, we know they're green, they're already green, they're already zero carbon or close to that. But you have to trust that the company you're investing in has that strategic intent to transition. So the barrier, I guess, is that credible definition that we can all use in a harmonized way to invest alongside each other.
Absolutely. And of course, one of the challenges is that we are asking money for something that will be gone in the future. So time frames become important. Latanya, let me come to you. Let me get your take as well.
Great, thank you. And absolute pleasure to be here. Thank you for the invitation. For us, we've been thinking about transition finance for about 3 years. We have taken a long journey to get here. I think as 91, a global asset manager today, but really with its roots in South Africa, and still South Africa is a big part of our thinking. We understood that it's really about the journey. It's not about the final destination. Green financing is really the final destination. The journey is the important part, particularly if you factor in social community aspects in places like Africa and South Africa, and rest of Africa and South Africa, I should say. And so it was a very long journey to get here. In the end, I think you have to go down the rabbit holes, but ultimately we've come back up to the top again to keep the definition on our side very simple, which is anything that avoids or reduces carbon, and something that you can measure and quantify.
Right.
In addition to that, it's exactly as Ellen mentioned a second ago, you need that strategic commitment. You need those commitments to conform with net zero within a reasonable time frame. So you need both the long term and the short term. You need to be able to measure so you can really articulate to investors. And then I think the other part of it is what we're really trying to do is commercialize the space to show people what returns can be generated. Because until that time, we are incredibly reliant on a donor-style, developmental-style ecosystem, which will get you so far, but not far enough.
Absolutely. And so I want to understand from your perspective why you think it took you so long. Is that the policy environment we're talking about? Is it because this is a new area that everybody needed to understand? What were the issues?
Absolutely. I mean, the concepts of greenwashing is real. And the legal liability. I mean, we've seen people being sued left, right, and center for effectively saying that they can do more than they actually do.
Right.
And so for us, it's been very intentional in terms of how we've come to define it. We put these things into commercial funds. We put these things into transition funds. What we do not do is go around and say this particular investment is a transition finance investment and give it that very specific label. So it's a bit counterintuitive. I'd say it took us quite a long time to get there, but ultimately our objective is really to scale and to get the underlying consumer, the people that live here, to actually enjoy the fruits of this.
Absolutely. Danny, I kept you for last because you're already practicing, right? You're in this space. Your thoughts initially on that, just the subject matter itself, and then of course would love to hear how your guys' journey has been.
Good morning, Godfrey. It's great to be here. It's a very important topic for discussion. Sasol has been a cornerstone of the South African industrial and economic landscape for the past 75 years. And it started with a very bold vision, and that is to create energy independence for South Africa in the 1950s. And since then, has grown up to be much larger than that, and today contribute probably around about 5% of the South African GDP, if you take all the indirect links in. It supports lots of jobs and industries around our facilities. But Sasol, as most international energy companies, are at a crossroads. How do you decarbonize whilst you be competitive, whilst you grow as a company? And that is the challenge that we've got. We've committed to our decarbonization journey. So we committed 30% reduction in greenhouse gases by 2030. We aim to get to net zero by 2050. And this is an interesting journey for us. It's really challenging, but it's going to require lots of investment, tens of billions of rands and dollars over the next few decades. And this is where transition finance now becomes really important. Transition finance is really that bridge between the carbon intensity of today's business to the lower carbon economy in the future.
Yeah.
It recognizes that companies like Sasol can't do this overnight. There's a journey, and we need to invest in that journey over time and ensure that we get to our objectives as we stated. So very important for us, a very important topic, and as also raised, we have to do it in a just transition way. Our communities, we have to take along. It's important that we create and keep our communities whole through this process, and also create the right infrastructure to develop that.
Yeah, you can't do it overnight, and you can't do it alone. You need partners, right?
Correct.
What sort of partners do you need?
I think partners is really critical.
Are you sitting next to one?
We need different partners. I think the reality is there is no singular company, industry. I want to say even government, that can do this and deliver this on this energy transition on its own. It has to be an ecosystem of partners, including different industries, bankers, BFIs, World Banks. All of them has to come together to create the right ecosystem for us to transition to the new future. Yeah,
I want to ask all of you to think about what kind of partners you require and what you want out of them. And we know that one of the big partners and of course a stakeholder is government. What policy reforms should we be thinking about that will enable this to be sustainable? Tsepo, can I come to you? And I want to stick a little bit still to the definition here and separate it from green finance.
Yes. So I think speakers here have already mentioned it, is there's quite a big difference between green finance and transition.
Are they cousins?
They are, yes, very close cousins, very close cousins. Because with green finance, as the point has been made, you're almost at the destination. You're funding something that is already green, sustainable today. Example being renewable energy. There's no emissions associated with the asset itself once it's in operation. But with transition finance, you will recognize that for some sectors, as I said, there is no alternative that could make it green today. But there are things that you can do in the interim to decarbonize or reduce the carbon footprint of that operation. And that's where the transition finance is. So you recognize the fact that this sector is carbon intensive. So how do I then reduce its intensity so that it can transition towards a low carbon economy?
Right. Okay. So I want to go back to the partnerships question, right? And I'll start the biggest partner on our table today. Ellen.
Well, that's a big compliment.
But you're active on the continent, right? And this is work that you already do.
Yeah, it's work that we're already doing. We've been working together with members of these companies on a collaboration on this since 2022, where we launched at the Egypt COP a guide to transition finance for Africa, so working on that definition. And then since then, I think there's been lots of developments in the market which are really welcome, including from ICMA or LMA or the Transition Plan Task Force, thinking about what a good transition plan looks like so you can prove that strategic intent that we've been talking about. So that's all building together to come to a place where I think we have more and more a defined transition finance definition, which we can then invest against.
How has it been? Has it been difficult? Has it been easy? What learnings do you have?
It's been, I think it is a difficult activity. Yeah, I think we'd all agree with that. I think you are really assessing something that is high carbon today, as we've all been saying, and understanding where the company is on that journey and how they would like to get to net zero. So there's a lot of future planning that needs to come from that target setting. Then there's a whole piece of work around what are the capex needs to get there, and then you can start to think about who do I want to raise financing for to meet those capex needs. So to use an example that brings it to life, if you're a steel company, you know that you need to change or upgrade some of the machinery. How much is that going to cost, and who would be willing to come in with that transition finance to support that journey? Yeah.
From your work around the continent, other parts of the world, have you been able to sort of develop or get a clear understanding of the kind of policy measures that would enable the supply of transition finance easier?
Yes, I mean, BI's work is mostly focused on, or we're a private sector investor, but using UK ODA money. So we're really focused on working with financial institutions or corporates who, for transition finance, have that strategic intent to transition, will develop the transition plan or have one already, and know what their financing needs are. So the things that we're really looking for are financial institutions who we can partner with, or corporates who are raising funding for that. So they're our most important partners. But I will say that governments really do enable this by having strong, clear energy transition plans that support those sectors to understand what government support is going to be in place, and also clear planning and oversight of things like carbon taxes, etc., which help with that strategic and financial planning I was just mentioning about. So the government policy environment is hugely important.
Absolutely. Danny, let's talk to you then. Have you seen that a policy environment evolving in the direction that you want? And let's add the partners that you need. I think, I can't remember who mentioned the MDBs and the role that they potentially should be playing in all of this.
Yeah, certainly I think policy and regulations is a really critical enabler to this whole conversation. What we require is very stable and forward-looking and supporting policies and regulations. It sets a bit the rules of the game for us. We know that we can then operate in that, we can invest into a certain structure, and that allows us then to secure the finance that's required to build out these projects. So that is a really important one. We also, if I can give an example, carbon tax is a really important regulatory policy angle there. You know, carbon tax is a bit of a signal of to the market. It tells us that carbon's got a cost. And it incentivizes business then to reduce our carbon emissions, and it helps from that perspective. But it's got a dual role, and I think we can also apply the revenues generated by these carbon tax much better than just having it filtered into the general fiscus, to be channeled into developing our renewable and green opportunities. Other co-financing opportunities like that, or redirected back into this decarbonization journey, that we can get benefit of that carbon taxes. And that's the type of policy and regulations that we would advocate for.
Do you feel, and I'm going to ask you a little bit of a controversial question here, do you feel that the carbon tax levels that we have seen to date are adequate, or they are punitive?
So the carbon tax levels, you know, there's always an argument on which is the right way. You know, you probably don't want to pay that, but it is a really important it's important lever to be applied through the industry, because it does drive certain actions. But as I said, The contra is, what do we use that revenues for? And if we can apply that revenues into the right direction, that's all good. That means that we can benefit and we can drive the right objectives for not only for the industrials, but also for our government.
Nathaniel and Tsepo, I want you to come in as well on the policy suggestions that would enable easier flow of money into transition finance. Nathaniel, I'll start with you.
Sure. I think from us, as I mentioned before, we're really looking at this as something that can be scaled to the size that we actually need. I think the requirements are in the hundreds of billions of dollars, especially if we're talking about the broader continent itself. And so, from our perspective, just as an investor and really directing capital from South Africa, from the rest of Africa and globally into some of these markets, the biggest factor is policy predictability and consistency. So less specific to transition finance. I think more importantly is, and we're seeing this across Africa, but also in other emerging markets, the emerging markets that are really cracking this are the ones that, from a policy perspective, are consistent. Through political change that takes place, they're consistent, and that really allows the scale and the type of timeline of investing that we're talking about here to materialize.
Are you saying you don't need policy specific to transition finance?
Yeah, I think, a lot of what, and it's obviously at the real infancy at the moment, as many of the panelists have mentioned, but really what we're talking about is going to be a trend that is commercial. It's a commercial viable project. It's a commercially viable business that you want to put capital behind. And so it's less about directing capital in a forceful manner down a particular channel, and more about getting capital to just pour into, in a confident way, to pour into markets like South Africa, into the rest of Africa.
Leave us alone, we can do this. Just make sure that the business environment is proper.
Correct.
We'll get it done. So,
well, I think from my side, it's also from a definition perspective. We've seen South Africa now has the green finance taxonomy that defines what is green for the country. So to the extent that can also be expanded now to say what qualifies as transition, so that will also help. And then also leveraging some of the existing reforms that we've seen. We now know there's a lot of tax incentives around energy efficiency, around renewable energy. So that's also directing policy into the right direction. We've seen all of the electricity reforms, whereby now private sector can participate in the electricity provision, and we've seen how much investment that unlocked. So I think to the point made around policy certainty and then consistency. So once as a country we agree this is where we are going, so we then ensure that systems that are put in place ensure that we can scale opportunities and also access these type of funds, therefore the definitions, and then ensuring that the policies are consistent as well, and then also they remain for some time so that we learn, and whenever there's changes required, then we make changes based on history and experience rather than haphazard changes.
So when we came in and we were chatting, I had a chat with Danny, and we spoke about one of the key issues that we should address here, which is the issue of the cost of the finance. We've got bankers, as I said, so I'm going to start with the banker here, and then I also get the other financier right at the end. And of course, please weigh in with your thoughts as well.
Yes. So that is always a contentious point, especially when you're talking to bankers. Yes. So it's understandable, and I think the cost of funding is a big issue, be it at the macro or the corporate level. I think the important things, we've also seen the emergence of new instruments, one of them being blended finance, whereby one doesn't only take one pocket of funding or commercial funding, you blend grant funding, commercial funding, concessional funding, and then you almost structure an instrument or an asset class that is palatable to the corporate itself, drives the right behavior, but the cost of funding is incentive enough such that you're not pushing a company or a country into debt. So we are finding there are instruments, that's why we have the likes of BI here, is to show that there is a collaborative manner that could be done to structure these type of instruments such that it's not debt heavy type instruments.
Explain why is it more costly than other forms of financing? Is it?
Relatively.
So then explain to me why.
So the blended, so when a normal commercial loan will have a certain pricing associated with it, but once you start going into this blended model, so whereby you bring in different funds, so some of them are concessional, saying that they can take long tenures, so anything 7 to 10, 15 years, And then whereas others are grant funding, so that all, when it's blended together, it brings the cost of funding lower, and it also gives you time to pay off the debt. So rather than being in a 3 to 5 year debt, but now it's blended, you can extend the tenure of payment, you can reduce the interest payment, but also the reporting transparency is also quite important, but then you can bring in things like technical assistance, whereby there is a consultant that will come and work with you, so you don't have to make that payment. So you're almost solving for the pain points. So you don't want a situation where you're just giving vanilla funding and then just waiting for the interest payments. So you're blending all of this from a technical perspective, also from a financial structuring perspective, that all the cost of funding in general is a bit more palatable.
I'm going to bring Danny last to answer this one, because I want him to hear all of you suggesting ways in which we can keep the cost of this capital down. Let's go. Nathaniel, you want to come in?
On the cost.
Yes. Yes.
Again,
I spoke about those trillions as well that are in the pension funds and that that you guys manage.
Not to be too controversial, but I think the thing we all yearn for is growth. If you have economies that are growing, consumption is high, people manage to sell their products, their goods and services, the growth rates get up to a level where there is a lot of reinvestment taking place and where the necessary investments to, for example, go through a transition exist. Some markets, India as an example, I was there 2 weeks ago, it's I mean, if you have 7% inflation, 7% nominal growth, and the good companies are adding an extra 5%, you're growing at 20% per annum. That gives enormous remit to raise financing, to invest it, generate equity returns, pay your debt at decent rates. I think what is tricky is Africa. Some economies are growing rapidly, but off a very low base. Places like South Africa, maybe some of the more developed economies, the growth has not been there. Why? All comes back to kind of policy certainty and confidence in the market ultimately. And so again, from our side, and really the more anemic the growth is, the more you are reliant on developmental financing, blended financing, real intricate structured projects put together, of which we're all kind of experts here, which are really important in terms of getting something from a 0 to a 1. But again, if we want to convert that 1 to 100, it's a different kind of. I think it's less about the rates, or the rate of the interest rates that you're charging on investments, or the return on equities that you're charging on investments. That should be coming. And so, I mean, we, for example, run one of the most successful, I would say, development or blended finance examples in Africa. It's called the Emerging Africa and Asia Infrastructure Fund. It's $1.5 billion. It's been going for 20 years. That together with our other funds have probably invested about 15 billion over the years, many of which have gone into core infrastructure, climate-related infrastructure, some transition projects. That is still, despite working at it tirelessly, a drop in the ocean in terms of what is required. So if you want to take that billion up to 250, which is the predicted amount of what's required per annum in this space, it's not through intricate structures. It's trying to get programmatic. And maybe that's another point back to the what policy frameworks are required. To the extent that things can get programmatic, then you have the likes of REAP, etc., that are great examples of what you can actually do when you get finance at scale pursuing an opportunity.
I have to say I reported on the launch of that fund how many years ago? More than 20 years ago.
2002.
Yes, indeed. Do you want to come in before I go to Danny?
Yeah, absolutely. I mean, I think reflecting on what I've heard both of you say, I think it is a new area, and it's one we need to scale hugely. The climate emergency is so urgent. So scaling transition finance at pace is what we need, and so blended finance in some situations where that's appropriate is going to be really useful. But I'd also, depending on the market or the company context, really encourage us to see this as a really commercial investment opportunity, which private investors can come into, have confidence in, and make good financial returns. Because if you're investing in transition, if you're a heavy industry player, you're preparing for the future. You're preparing for the future policy and tax, etc. environment with long-term investment that is going to make you hopefully reduce energy costs and have that economic resilience. So I do think in many situations this is a great investment opportunity.
I've got a question on returns, but I'll park it for now. Danny, come in.
You may now pick up a bit of tension here between us and the banks. Of course, our view is that the finance rates are on the high side. Cost of capital for projects allocated to the African continent, particularly sub-Saharan continent, is much higher than what we see in the rest of the developing countries. And it's to do with a bit of historical defaults on debts.
And perceptions.
And we really need to challenge that and see how we can reduce the interest rates and the cost of capital. Blended finance, I think, is really important, and it's a really big lever how we can reduce the cost of finance. A lot of these projects that we're busy with is not only the project at the end of the day, but it also develops infrastructure along with that. If you take a big hydrogen project, for example, that we looked at Boegoebaai, there's infrastructure that gets developed with that, ports, roads, grid, and I think there's opportunity for World Banks and other places to really put grant funding into that to reduce the overall cost of the debt. Ultimately, it has to be commercial and make commercial sense. And you have to get the offtake to make sure it works at the end of the day. So we acknowledge that, and I think we can work within those terms. But I think there is also a bit of need to drive down those costs.
So you're saying the funding is there, but it is expensive.
It is expensive.
Sure. Okay. Do the bankers want to respond? You have to respond, right? You addressed it in part.
Yes, I think we addressed it in part, and there is an acknowledgement that but it also started at the macro level. That if 100%. The country has to be stable, and then as Ned has mentioned, there needs to be growth. So if you start seeing growth and stuff like that, you'll see naturally when there's opportunities and money is flowing, there's development, money is coming in and out, and products are flowing. You'll see naturally with that also the cost of capital will come down, because now that's happening in a growing economy. I think in a stagnant economy, things start to become a bit tricky when starting to find how to structure deals appropriately. And then obviously now we're in a constrained environment. But so that's the type of thing.
We are in a very constrained environment, because now the policy uncertainty you speak about is an everyday thing. We deal with it every day. Nathaniel, I want to come to you and talk about the return on investment on these on transition finance. Have you had to perhaps walk away from projects because you are not getting the return that you want? Is it harder to get the rates that you want, the hurdle rates that you'd like to get for you to be active?
There are many dynamics on this panel. We invest heavily in Sasol, BII invest, and we co-invest alongside them. RMB, big partner of ours as well, in terms of the creation of these projects. I mean, for sure, there have been many projects where we've thought, okay, the viability is just not there. Why? It's partly to do with this risk perception, and for sure it exists. I can say that categorically, that you go elsewhere in the continent and the desire to want to live in Johannesburg is a shock. The perception is you're going to end up in trouble very quickly here. So I think the main thing is really absolutely over time. I expect things to come down quite significantly. I think infrastructure at its core is probably a 3, 4, 5 in hard currency % premium that you're picking up for these geographies, and that makes it, as you say, Dani, it makes it more difficult to finance projects here. It's for all the reasons we've mentioned before, but policy is probably the biggest one. FX, affordability, all of those things, which ultimately, again, come back down to policy. And so really, to the extent that you can get an economy, the confidence in an economy, that you have a clear goal like Saudi Arabia does or an India does, a 10, 20-year clear vision that everybody falls in behind. I think that's really where you're going to see capital flow, and it's simple supply demand. If there's lots of supply of capital, things are going to come down. If there's not that much supply of capital, the demand is high, it remains out of kilter. But I mean, there are many solutions in terms of capital being provided. It will do for now. It's status quo. It probably grows at the margin. But if we really want to leapfrog, that's really where we need to get policy involved.
Let me get you, Ellen.
I was just listening in very much, agreeing and appreciating those inputs. I think I don't really have anything to add to that point. I think we've well covered it. But I mean, I think the two things I will, add to our transition finance conversation is really around the social aspect of transition finance and how we think about the social aspects, job creation, skills, etc. within these transition plans. And I think also we should mention the importance of disclosure. We've talked a lot about strategic intent and how that's part of the definition, but actually disclosing where you are versus those plans and targets is an absolutely core piece which you shouldn't miss off the definition. So I just wanted to add that in.
Yeah. Seppo?
Yeah, I think that is true because as we said, with green finance, we know that something is green, no emissions day one. So the reporting is not as robust. But when it comes to transition finance, because you're now funding something that's carbon intensive, with that there's increased sense of we need to see that you are on that pathway. And if not, we acknowledge that things do happen. Why are you not? And what have we put in place to get back to your pathway? Because the important thing is there needs to be a way for us to quantify the actual emission reduction in tons CO2 emissions to say this is how much you've reduced this year and this is how much it compares relative to your baseline or what you intended to do. I think that to the point around transparency, that is something that's different in transition finance because the asset is still carbon intensive. So you want to see that progression towards a low carbon operation.
Do we need to lower our requirements for returns on transition finance, given the important role that it plays? And I'd like Danny to come in and weigh in on the community aspect, because we're really doing this for the greater good to make sure that we're not disadvantaging one section of the population. But I wanted still to pose that question to you, Tsep, before I go to Danny.
So for me, the way I look at it is the other way around, from an opportunity perspective, to say transition finance is not saying compromise your returns or compromise what you're doing now just for the sake of this one item. What it's saying is view transition from an opportunity perspective to say what enablement does it bring for you when you incorporate this low carbon operation? Because the point has been mentioned, there are now carbon taxes. So to the extent that you reduce your emissions, you can now also reduce your carbon tax liability. And also we've seen with clean technologies, renewable energy, the tariff that you get from a renewable energy asset, I think they average anything between 50 cents to 1 rand per kilowatt hour. Whereas your typical electricity tariff, anything between 3 rands and 5 rands. So just from a business perspective, by you moving from from carbon intensive sources to less carbon intensive sources, there's also now that incentives that from an OPEX perspective, you've now also reduced your OPEX and therefore your earnings also get a bit higher. But we've also seen on the other side that there are some customers that are willing to provide a premium for a low carbon product. So if you look at it from that basis, we're not saying reduce your expectations from an returns perspective, but acknowledge the opportunity that it presents when you now embrace transition, because there's all these benefits that you are missing out, which are now translating to opportunity costs by you just continuing business as usual.
Got you. Danny?
I think it's great points from that perspective. And ultimately, this ecosystem needs to work. And part of that ecosystem is our communities and the people around our facilities and how we protect jobs in that environment. And to us, that's a very, very important criteria as we develop this new low carbon opportunities. Even when it's not close to our facilities. If you take the Northern Cape, there's fantastic opportunities to develop low carbon energy solutions there in an area that is blessed with sun, wind, but not a lot of economic activity. So upliftment of that economies and the people there is a really important factor to play. But ultimately, we need to make sure that we reskill our people, keep our communities whole through that transition. Otherwise, it's not going to be sustainable. And there's also other opportunities like carbon offset opportunities that we can generate really community uplifting projects in those areas that can uplift our communities.
I was actually going to follow up and ask if perhaps there's need for government to rethink the incentives that it has in place for enabling this kind of financing.
Certainly, I mentioned earlier that one of the easier things that we think is possible is how do you direct the revenues from carbon tax into those opportunities In that you are meeting both the country's objectives as well as the decarbonisation objectives and the community objectives. That's one example, and there's certainly opportunity to look at that and to be more supporting in terms of that. I think the point raised around consistency of our policy and regulations still is the most important thing that we need to get right.
So I know you guys, your DNA is to innovate. Any clever ideas that you could suggest for government to try to enable more money to flow into the sector?
Yeah, I think that point made around those carbon taxes that are being collected, being redirected, I think that is quite an innovative way.
So rather than going into the big pot, into the national treasury, it needs to go into a specific vehicle that enables reinvestment into those kinds
Correct, because it then incentivizes the right behavior, and then you'd see more corporates embracing these low carbon technologies. And I think we've seen snippets of such happening, be it indirect. As I mentioned, there's the energy efficiency tax incentive that I think provides corporates with tax allowances when you achieve a certain percentage of energy efficiency improvement. We've seen also the renewable energy tax incentive as well, whereby you can reduce your tax liability with the capex that you provided for adopting a renewable energy asset. We also have the research and development tax incentive that also you can reduce your tax liabilities. I think we've seen snippets, but I think if that could be packaged in a programmatic manner, whereby this is a basket of tax incentives and also other forms of incentives, because you're not saying government, you're losing money, you're saying the money that was paid for carbon taxes gets it redirected here, and how can we use it to decarbonize our economy?
Absolutely, So the other part to my question was actually who should be paying for this work that needs to be done, so Danny is able to deal with the communities where he is operating in. And that, you want to come in?
Yeah, that's the answer.
You stand on existing protocol.
No, on a serious note, I mean, there's a lot of technical funding that is available at the very kind of start of many of the viabilities of some of these projects. But yeah, I mean, I don't have much more to add on that particular topic, to be honest. Again, I think scale, I sound like a broken record, but scale is really simplicity. And to the extent that we can actually get things across into a more simple, digestible format. I mean, we're speaking to some very technical people on the panels and a lot of the audience and audience that's dialing in. But effectively, to a trustee member sitting on a board that we would typically be presenting to try and encourage to think about transition, but before that, energy, before that, infrastructure, before that, thinking about allocating into alternates. And actually, if anybody's made an investment into some of these, the technical, legal structuring work behind each and every one of these investments is immense. And so really to try and dumb this down and digest it, put it into simple, broad portfolios, training and education, I think is a big part of it as well, just in terms of actually getting people comfortable with the fiduciary duties that they have and the confidence to say, yes, I'm going to put this next rand into these core infrastructure projects, which ultimately is going to help my backyard and effectively help the next generation, not just in terms of return, but also in terms of what actually comes out on the other side as a good or service.
Ellen, you want to come in? Examples from other parts of the world where perhaps incentives have been put in place that have enabled a working solution to getting more money in.
I think we've really covered a lot of them. I think it is having that clear plan for transition at country level, which then gives investors confidence to invest in that market, and then having companies which have that strategic intent to transition, a transition plan that they have already or working on. And I really like that we've really covered the social aspect of the transition, and the Transition Plan Task Force has recommendations within how to write your transition plan to think about those jobs that are needed, jobs created, any jobs losses or jobs transference, and what the skills are within your company that you need to develop to embrace the technologies of the future. So I think those are learnings that we're seeing in the market that are really helpful, and I wanted to highlight today.
Absolutely. You want to come in again?
I think it's important to connect the dots here again, because it's not also sounding like a broken. It's about the ecosystem that we put together. Let me give you perhaps another example just to illustrate how this can work. For example, we've agreed a partnership agreement with Anglo in terms of developing energy crops for renewable diesel. We take degraded mining land, we farm crops on those farmlands.
Okay.
We provide jobs to the community. We take the oil and we process it through our facilities, and we make a low carbon diesel from that. Those are the opportunities that we really need to explore in this context and see what is really fit for purpose here in the South African environment as well.
Absolutely, absolutely. Thank you very much for your thoughts. I would like to open up the debate with your permission. Yes, thank you. You have agreed to the audience that we have here with us. If you would like to participate, please raise your hand. There's a roving microphone. And if you can perhaps try to ask your questions in as short a time as possible. We've got a hand here. Where is our microphone? Where's our microphone? It is right here. Thank you very much. Identify yourself, say, and welcome.
Thanks, Godfrey. I'm Mielani Mkabela from Antwisa Capital Partners.
Thank you.
I'm Mielani Mkabela from Antwisa Capital Partners. But I just want to understand from RMB and British International Investment, how much budget have you allocated on transition finance? Mainly when you look, the impact or the need or the highest need is at Mpumalanga, where electricity generation in South Africa is taking place. RMB, whether that transition finance, Tsepo, maybe you need to move and set up your office at Mpumalanga because that's where the need is located. I mean, I think that is one of the things that, like if focus is there, we can work around that because almost maybe 60% of your budget might be expected to be used at Mpumalanga province. But how much do you have, like as British Investment Finance and RMB allocated for such?
Thank you. Thank you.
Yeah, I think maybe in answering that question is, I think it's first to clarify that transition finance. So it's broader than just energy.
Right.
So so it also involves decarbonization in other sectors, like as you mentioned, iron and steel, aluminium, petrochemical. Yeah. So it's broader than that. Yeah. And then remember, its objective, it's not to decommission things.
Right.
It's more to decarbonize, recognizing the carbon intensity or the hard to abate nature of some of these sectors. Yeah. So that's the important part.
Them as it were.
Yes. As we are looking for alternative technologies. So it's not a competition of do this and then switch off this one or do this against this. So it complements the broader ecosystem of financing and energy security that every country on the continent is trying to achieve.
Yeah.
Right. So that's the one point. I think from a commitment point, as a bank, as part of the group, we are part of the First Green Group, there's a commitment that the group has made around sustainable finance and transition finance facilitation. It's about it's 200 billion by 2026. So that is money that we have committed from a facilitation perspective that will facilitate flows of about 200 million, both in sustainable and transition finance. So we look for both opportunities.
This is across the continent.
Across the continent, and it's not only RMB's balance sheet. We will also leverage other funders, be it DFIs, be it institutional investors, bring all of those pools of capital together, and then that's how the commitment was made, but driving both sustainable and transition finance.
Yeah,
yes.
Great, thank you. Ellen?
Yeah, just absolutely echoing that. So the transition finance, it's great if it can be focused in coal regions and really thinking about that just transition, but as you said, it's broader than that. It's around heavy industrial sectors, iron, steel, aluminium, cement, etc. Those really hard to abate sectors. And for all investors, BI is no exception. We can invest where there are projects that are ready to take that finance. So Where we are in climate finance, because that's an established area for us, we've absolutely scaled our ambition there. So BII has a target that 30% as a minimum of our commitments every year should be in climate finance. So that's things that are already green.
Even in this environment?
Even in this environment. And I'm happy to say we've exceeded that. So last year we committed over 40%, that's and great. That has equated to over $2 billion USD over the last 3 years. So we're absolutely deploying green finance at scale. As I mentioned, I think at the top of the panel, transition finance is so early that we don't have a volume target yet, but we absolutely need to, both driven by our sustainability ambitions and against our net zero target. We absolutely want to deploy more transition finance. So I think this panel is kicking this off, bringing us together, talking about that definition, and I think we all need to work together, the companies and the investors, to bring these investable opportunities forward, and then let's deploy at scale. And I hope that we, as a community, get to very large volumes of transition finance over the next decade.
I'll take a couple more questions. I've got one here that's come through from online. I don't know if anyone will be able to answer this one. It asks, to what extent will today's discussions find expression in the B20 resolutions during the summit next month?
I think the conversations are already there. So as I think it was earlier mentioned during the opening remarks, that there is a working group within the G20 that's looking at energy mix and just transition. So the conversation has already found home there. There was also a mention of some of the recommendations that have come out. So I think we can confidently say that those conversations are already happening, and there's a dedicated working group looking at transition finance and energy transition in general.
Absolutely. All right. I'll take a final question. There's a hand here. There's a hand here. Or I take two?
That was my question.
Yes.
Oh, that is a question. One has been answered. Okay. I can maybe squeeze two more. The last ones.
Thank you very much, Godfrey. I'm going to direct this to my friend and colleague at 91. My name is Dr. Hubert Dan, so I'm the CEO and Chairman of Africa Investor. We're an institutional infrastructure investment platform for African pension and sovereign wealth funds. I've heard a lot about people talking about scale, but are we talking about scale in a model that's not scalable? And this is our challenge. Our challenge is the blended finance model is well documented to actually only be able to accomplish about 8 to 10% of the private capital mobilization that's actually required. So we actually have a 90% gap that can only really be genuinely filled by institutional capital, pension funds, sovereign wealth funds, insurance investing platforms. So my question to our friend at 91 is, what needs to change? And our mantra has really been, if we really want to get this capital at scale, we need to stop trying to make investment developmental, and we really need to make development investable, and really create that emerging asset class that capital can flow towards. But I think G20 really needs some guidance on that, because we sort of see, we're encouraged to keep going through this blended finance model, which in some cases increases the perception of risk to us, on a risk-adjusted basis. So love some truth to power here, because this is the unlock. There's over 300 trillion of assets available for this type of opportunity if it's packaged as a globally competitive investable asset class. But we seem to be obsessing with this blended approach to a global collective balance sheet of multilateral and concessional capital that's only 1.5 trillion. So I'd love to get your guidance on that. Thank you.
In terms of what is required in blended finance, it's I guess the central message is how do we commercialize this to get to the scale? I think we need blended finance, but for what? It's not the sustainable solution, it's the catalyst. So it's really, the way we think about it is we need first loss capital to attract investors, to get over the concern around the perception of risk in many of these markets. Once they're there, once they start seeing the returns that are generated, and then in fact these first loss or guarantees provided are quite often not even utilized, you then manage to flip that switch more permanently to say, great, we can actually do this at a commercial scale, and you can lend, you can invest, you can buy businesses here on a completely arm's length basis and make those returns. So I think that for me is the big one in terms of we're really trying to push through that blended finance, because it's not the full answer. But and it's also just kind of how we articulate the risk and the returns. It's difficult. It's a journey. You need a very long-term mindset.
Absolutely. We come to the last part of our discussion. Can I ask for my contributions, lady and gentlemen? Nat, I'm going to begin with you right at the end, and then we come inward.
Can you rephrase the question?
The question, sir, is what recommendations, what action point do you think we can take away from our discussion today?
Big question. But I think collaboration is the first most obvious.
Yeah.
There's a full chain. I think we all almost sit at different parts in this chain, and to come together at events like this, but also to make representations globally, I think is pretty important for us to do, and convince global allocators of capital that actually there's a destination, that technical knowledge is here, the businesses are here, the underlying projects are here, there's real investment opportunity, and just combining that with the confidence that they need in terms of policy certainty. So I think kind of stakeholder engagement is really a big one, both locally but also importantly globally.
Absolutely, thank you. Danny?
I think important to realize that the energy transition is not just a technical challenge that we've got, it's really economic and social challenge that we have. And we've got to look at it from all those aspects. Ultimately, it is about how do you put together the ecosystem that provides the right quality of projects, the decarbonization roadmaps, journeys, and we're absolutely committed to that from our perspective. And how do we blend all of that together into something that's workable and we can take forward from that perspective? And I think if we can get all those pieces together, it will really put South Africa into a nice trajectory of a greener, more resilient economy going forward.
Absolutely, thank you. Ellen?
So 2 takeaways from me. I think the first one is, get excited. This is a new area of sustainable finance that has huge impact potential and it's very attractive to investors. So novel area of sustainable finance that we really need to scale quickly that is different to green finance. I think that's a clear takeaway from today, that there are emerging definitions of how you define it so we can start using them to start deploying that capital. And then I think the final takeaway is, don't let perfect be the enemy of the good. The definitions still aren't fully harmonized, but we are really getting there. But we can work today with the companies in our portfolio to decarbonize them, and we can work today with investors to start thinking about how to label transition finance and deploy that more. So let's, get going at scale.
Thank you. Tsepo?
Yeah, I think from our side is we do acknowledge that the continent's transition comes with challenges. However, we, from an RMB perspective, are much more excited about the opportunities that it presents. And I think we look forward to the partnerships that will be unlocked as a result of this new thematic focus. And we are saying RMB is open to this type of opportunities. We're looking forward to partnering with both our clients, the broader society, in terms of ensuring that the continent as a whole decarbonizes, remains competitive, and we embrace these opportunities and then see how we can reindustrialize the continent once again with this opportunity that it presents.
Yeah, I'm hearing partnerships, I'm hearing collaboration, I'm hearing scale, I'm hearing people. This is about building ecosystems that are important for the future. Lady, gentlemen, thank you for your time. Please help me to thank them for their inputs. Thank you for your time again.